Hey, this is Matt from Let's Not Be Fools. Let's talk about the top 5 advantages of mutual funds, or at least my top 5. Number 1 is diversification. When you buy a single stock, all of your money is riding on that one stock, and that's a very risky proposition. Whereas with a mutual fund, you are going to pool your money with a bunch of people you don't know, a bunch of strangers, and you're all going to put money into this pool. And some manager at some investment company, Vanguard, Fidelity, whoever is managing the mutual fund, is going to make purchases of stock with that pool of money, and they're going to buy bunches of stock, and you are going to have diversification because now your portfolio is made up of all these stocks. So if any one stock goes down or goes bankrupt or whatever, it doesn't hurt you so bad. You have all these other stocks in your portfolio. So again, you're pooling your money with a bunch of strangers, and we're all going to purchase all these stocks together. We're going to hold them together. We're going to get that diversification, and that's a good thing. It's much less risky than just holding 1 or 2 stocks. The number 2 advantage is liquidity. You can easily pull your money out of a mutual fund. Usually by the end of that day, they will settle with you, and then it may take 2 or 3 days to transfer that money back to your bank account. But just know that you can always get that money out rather quickly, maybe not as quickly as an exchange traded fund where you can actually trade in the middle of the day, but it's still as liquid as anything else pretty much, so you're pretty safe. And again, liquidity is a good thing to have because it's not like you're locking into an investment for the long term. You can always pull money out, and because you are diversified, you're not facing the risks of pulling out at a low point. If you had a single stock or 2 stocks, you have a bunch of stocks, so most likely the volatility of that fund isn't so much as to where you're going to be pulling out money at a total loss. I'm hoping when you invest in a mutual fund, you're in it for the long term, so liquidity is not an issue, but it is there. If you need it, you can always pull your money out very easily. I'm going to call my number 3 access to many stocks for a low dollar amount. So when you buy into a mutual fund, you're buying into exposure of a bunch of stocks. Could be dozens, could be even hundreds, depending on what kind of mutual fund it is. But as such, you are getting access to all of those stocks at a very low dollar amount. You could even probably invest as low as $1,000 or $2,000 or $3,000 in a retirement account, or even maybe even a regular trading account. You don't have to be limited to the amount of money that you have. If you only had $1,000 and you just wanted to buy stocks, you really only have access to 1 stock or 2 stock with that $1,000. Whereas with a mutual fund, you can take that same amount of money and get exposure to a lot of stocks and get that diversification. Number 4 is variety, and who doesn't like variety? So with a mutual fund, you could target all sorts of classes of stocks or bonds. So you could buy a bond fund, you could buy a stock fund, you can buy a mixed fund where there's both stocks and bonds for a more conservative mix. You can target growth stocks, you can target value stocks, you can target income stocks, whatever your target is. And number 5, I'm going to call autopilot. So you can invest in a mutual fund and then just sit back and enjoy your life and just let the investment managers of that fund decide what stocks they're going to put into that fund and what they're going to hold and move it in and out of. You just have it on autopilot. You just keep putting money in consistently over time into the right kinds of funds, and I'll have another video about my preferences on what kind of funds to invest in. So you just sit back and let the portfolio managers do what they do, and then hopefully in several years or decades you'll have a nice big sum of money in that mutual fund. While we're on the subject, I just want to address a few of the drawbacks or negatives that people bring up in terms of mutual funds. One is that a lot of them have high costs, and they do. Some have loads, that is fees to get into the mutual fund, an upfront fee, a percentage you got to pay just to participate in that fund. Others are no load, which I prefer. And then there's the management fees. So in addition to the load fees, some may have very high management fees. So it could be 2, 3, 4, 5% per year that they're charging you on your money just to manage that portfolio. And those are very high fees. I suggest you go with low fee mutual funds. There are many out there, many available. Another drawback is the amount of cash holdings that a mutual fund has to hold. So when you're in a mutual fund, let's say this is the pool of money in the fund, and the managers are going to buy a bunch of stocks in there, but they're always going to have a certain slice in cash, so that when people are leaving the funds or withdrawing their money, they have that cash to pay out to those shareholders. So they always have to have some money on the side here, so they're not always invested 100% of all that money into stocks, probably 90, 95% of it, depending, but they do want to have some cash reserves to pay out people who are redeeming their shares, as well as have money for future opportunities to buy stocks where they want them. So ultimately, the criticism is you're not 100% invested in stocks when you're holding a mutual fund. Again, they have those cash reserves. So when the stock market goes really high, you're not getting the full benefit of all those stocks, because had they just put 100% into stocks, you'd have a much higher return. But obviously you could see they really can't do that. Another criticism is the difficulty in comparing mutual funds, and that's true. You may have a bunch of mutual funds from different companies that are focusing on growth stocks, but they don't hold the same growth stocks. They all have their own ideas of what a growth stock is, perhaps. Maybe the underlying assumptions are the same, but in particular, they may be going after different companies. They may be holding a different pool of stocks in each case, and a comparison of each is very difficult. Anyway, so that's my top 5 advantages of mutual funds. I really do like mutual funds, and I think most investors should focus on mutual funds instead of buying individual stocks. There's always a place for individual stocks in your portfolio, but it should be a minor place. Let's just say any stock shouldn't be more than 4 or 5% of your total portfolio, and I would make the majority of your portfolio made up of mutual funds, 1, 2, 3, 5, however many, depending on your goals, and we can cover that in another video. I hope that was helpful. This is Matt from Let's Not Be Fools. Have a great day.